What's up, Wealth Elevator listeners? A lot of you own small businesses. A lot of folks come to us once they've had a nice successful exit, typically in the $5 million, $10 million range. And when you do that, you're going to realize taxes. And today I have a CPA with us to discuss a very particular topic that is leveraging ESOPs, which is a way of exiting your business in a tax advantage way. They always say it's better to start thinking about your exit sooner rather than later and making yourself replaceable so you could sell. I'm going to introduce Steve, our CPA, on the line here. We connected through the Vistage Network. It's a group very similar to YPO or EO. It's a board of advisors, CEO group where I go to once a month. You guys do the same thing out there in Connecticut. But so we get it's a nice social group for us personally, and we get a lot of good business ideas, but we also tap into this global network, which is where I reached out to Steve and where we instantly got connected and discussed what would be good for the Wealth Elevator listeners to do a deep dive on today's webinar. But Steve, why don't you take it away, introduce yourself?
Thank you so much, Lane. Again, it was fun to meet you through Vistage, and I've been a Vistage member for a little over 11 years, and I can't tell you how much value I get from it. And I've actually been speaking to Vistage members all over the country and really giving advice and helping them figure out the next steps in their journeys. One of those things, as we spoke about, is this whole concept of really exiting, an exit strategy. And one of the reasons ESOPs is one way that a company could think about, a business owner could think about exiting their business. And one of the things, as you see right there, is when you talk to business owners and you ask them, where is their wealth? And the overwhelming majority, over 80% of business owners, most of their wealth is tied up in their businesses, as opposed to in investments or even in real estate. So if someone has a business doing $10 million of business, if they're making $1 million a year, they might think it's worth several millions of dollars, $5 to $10 million. That may be a very significant part of their wealth. How do you monetize that wealth and try to diversify, which obviously in your world and my world, you hate to have 80% of anything tied up in a business that's dangerous. God forbid the business takes a downturn, you could lose a lot of that wealth very quickly. So one of the things that people could do is think about selling the business. And one of the ways to sell is potentially through what's called the leveraged ESOP.
We talk about this a lot in terms of investing. Some of our clients, not business owners, and by the way, if you're not a business owner, probably stop listening to this webinar. It's not for you. There is a little bit parallels if we talk to people about maybe the 1031 exchange isn't the best for a lot of people because what it does is it concentrates your wealth into, you got a 4 unit, then you got an 8 unit, then you got a 15, and then 24. You're concentrating your wealth into a handful of assets, a handful of geographic locations, and that's the opposite. What we're saying here in terms of your investments, in a way your business is your investment too, especially when you want to slaughter that cow and get that nice payday at the end there.
It's more than their investment, it's their baby, right? When you have a business and you nurture it, it's your baby, and you want it to succeed and be healthy and be strong, and that's all getting itself ready to potentially sell. And the reason we're talking today is that when you want to sell a business, there's a lot of different options that you might have when you sell a business. And there are 3 listed here. We're talking about the one over to the right, and that's an ESOP. An ESOP is really essentially selling your business. You're selling your business to your employees indirectly through an ESOP trust. And it's following the ERISA guidelines. I'm not going to kid you, but it is definitely one way to potentially sell a business. And then there's other ways. In the middle, it would be a traditional sale, an M&A transaction, either selling it to a third party, selling it to private equity, a strategic buyer or financial buyer. And that's clearly something that any business owner that's going to sell is going to be thinking about. And to be honest with you, there's more of those transactions than there are ESOPs. And then a third way, really not necessarily to sell the business, but just to get some money off the table, I'll call it is really a leveraged dividend. And that's really where you just take some money out of the business, if you are able to, and just take it out and put it somewhere else. You have the $10 million business, and maybe you want to take out $1 million or $2 million out and put it in other investments, a form of diversification. Now you could do that, but there's obviously strings attached. The company's got to have either money in the bank to do that, or the company has to have the ability to borrow the money from a lender in order to do that. And again, that's something that could be done. It's not as advantageous from a tax standpoint, but it's certainly an option.
And while we have this slide up, this is a bit self-serving, I suppose, but one of the things that we do, other than buying apartments and doing oil and gas deals as an investment group, but we will also partner with operators if they would like to a liquidity moment to get some cash out of their business. I think as a business owner, and I see this with my colleagues too, is like, this is your baby, right? As you said, Steve, earlier. And a lot of the employees that you have in your company, these are not huge companies, so you know these people personally. Yes, they would like to exit, but they don't want to sell to faceless PE, which usually comes with a very negative connotation. Maybe not as bad as like Car Icon come in, take off all the heads of the managers and the director levels and cut costs, increase pricing overnight. But ESOP gives you the option to give the ownership to the employees. It is the spirit of the whole thing. It is a little bit more friendlier way of doing things if that's one of your concerns. Or just sell it to us, right? Work with us, and then that way you can take some chips off the table, take some money off the table, get paid, have a nice vacation, go on a nice cruise, live out your remaining years, but also still have control and impact over your employees' lives.
Yeah, you're right, Lane, 100%. The ESOP really gives you total flexibility, and we'll be getting into that with some great tax advantages, which is not available in the other options. It doesn't matter what you sell it for, it matters what you net in your pocket. And it's very important because you could sell a business for $10 million and net out with 6, or theoretically in an ESOP, if you could sell your business for $7 million, but you end up with 7, you actually did better, even though your selling price was lower. So it's really important to understand that, and we'll talk a little bit about that, but always got to consider the tax ramifications. And then you're right, the social and people like the legacy, that legacy concept. There really is some ways to figure out and think about really what do you want to do, and I call that knowing your why. Right? What is the point here? What does the owner want? What is he looking for? You want to suck out every last nickel? And that's fine. A business owner could have that intention, but if you want to do that, you're probably not going to do an ESOP. But if you really love the idea of legacy of your business, you want to empower your employees, actually give your employees a wonderful benefit, and really be able to stay around, then maybe an ESOP is for you. And that's really what we're going to try to get into, really making people aware. And I think most people just aren't aware of ESOPs, or if they are aware, they've heard of them, but they don't know what they are. And they're afraid of them. And I want to try to eliminate some of that fear because it deserves a discussion, and that's really why we're doing it today. Here, just doing a deal, whenever you want to do a transaction, if you want to do an M&A transaction, you need to find a buyer, right? Because there's got to be two sides to every transaction. What's really interesting about an ESOP, a business owner could decide to do an ESOP. He doesn't need to find the buyer. The buyer is staring you in the window. It's essentially you. The company is buying it. So one of the great things about an ESOP is that you can find the buyer. You don't need to worry about finding a buyer. The buyer's already there. You're really looking in the mirror. It's you and your employees. And then there's tax benefits and legacy issues as well.
Yeah, but you can, at some point, turn it to ESOP, and maybe a generation or two later, you can sell it, right?
And that's the great thing about an ESOP as well. You don't need to sell 100% of it. You could sell a minority. You could sell 30% of the company to an ESOP and still keep 70%. That's a lot of ways, a lot of people, and you still get all these great tax benefits we're going to talk about. There is so much flexibility in an ESOP that is available to business owners, something to be talking about. And again, it gives you an opportunity, as we said over there to the right, to ease out. Let's assume you have a business and you don't want to outright sell it, but you want to take some chips off the table. And if a company is worth $5 or $10 million, you want to sell 30% of it, or 40%, or 49%. If you don't want to sell a majority interest, you could do that in ESOP and get some money off the table. And then later, go back again, 3 or 4 or 5 or 8 years later, you could sell it a rest. You could either do another ESOP or you could sell it to anyone you like. You got that total flexibility. And you had some money off the table, which is really nice as well. One of the things about an ESOP is the way that the ESOP gets financed is very payroll related. A very small company is not going to be a great candidate for an ESOP. If you have really less than $1 million of EBITDA of earnings, I would say you're really not going to be a great candidate for an ESOP because you need to have employees, at least 3 to 5 employees generating at least $500,000 of payroll a year. If you don't have that kind of payroll, you're not going to have the wherewithal to finance this transaction because essentially it's financed through payroll.
Yeah, it reminds me of an HOA on a little real estate property. Like I know we had on an apartment, we had an HOA in like 4 apartments. It was such a pain to deal with and legal costs.
Yeah. Yeah, there are small ESOPs being done. I'm not going to kid you. The clients that I'm dealing with, they're really, I'm not talking to clients unless they're making at least $1 million. It just, there's cost involved. It's a transaction, not different than an M&A transaction. You need professionals, you need attorneys, you'll need valuation experts, and there's cost associated with it. If your business is doing less than $1 million of EBITDA, in my experience, the cost probably will outweigh the benefits. That's my take on that.
Tell me about this minority or women owned. Like, what is the benefit to doing that?
It's funny you say that because I was just speaking to someone. He's a minority owner of a business. He owns a business in the apparel industry, and he sells very beautiful men's tailored clothing. And I was in Macy's actually, and he had a beautiful display in Macy's, and I met him. He's been around for 15 to 20 years. One of the reasons he got into Macy's is that a lot of the big retailers, they have programs where they want to promote minority-owned businesses. And so they will carve out a space for them and make them customers. So that they carved out a space in the store for this is the area where we're going to sell minority-owned business owners. And he got a space in Macy's selling his stuff in the store. They gave him a small order to start. And now he's doing millions of dollars with Macy's. And he's more than holding his own against everybody. So the reason, a lot of reasons why people want to be minority-owned businesses is that there are opportunities, whether it be in retailers like Macy's or if you're selling to the government. Again, the government, they want to promote minority businesses and they will carve out contracts for minority business owners. So if you do an ESOP, one of the great things about an ESOP you could do, if you sold your business to private equity, if you're a minority owner and now you sell it to private equity, now it's not a minority-owned business anymore, so you'd lose that status. But if you did an ESOP and you sold 49%, to the ESOP, you're still a 51% minority-owned business. You won't lose your minority-owned status even though you sold part of your business. And it gives you your cake and eating it too. So it allows you to really get some money off the table, monetize some of the investment, but still, if you want, still keep that certified minority-owned business or woman-owned business status so that you don't lose some of your customers as a result. A lot of minority-owned businesses, if they don't want to lose that minority-owned status, an ESOP transaction where you don't sell a majority of it to the ESOP is a great way to do that. Very interesting. So again, what I said about these ESOPs is there are ESOPs in the country, but there's only 6,500. That's not millions. There's millions and millions of small businesses out there, but there's really only a small number of ESOP companies out there. And I think that's mainly the result of just ignorance in the marketplace and people just really not understanding that this is a real viable option, but it does need to require some thinking, and you need to think about it, and you need to have people around you that understand it, and it needs education. If I speak to a lot of my competitors, I find that if you mention ESOPs to other CPAs, the immediate reaction is, no, it's not for you. It's too complicated. And I say, no, I totally disagree. I said, I don't know if it's for you, but let's discuss it. Let's have a real honest discussion about it and let's think about it. Because again, it isn't for everybody, but if it's for a minority of the population, let's give it a good discussion and let's see if it's for you and then make that decision one way or the other. And so that's really important. Okay. So now really let's just focus in more on this concept of ESOP. ESOP, by the way, is Employee Stock Ownership Plan. That's what the acronym stands for. And an ESOP, by definition, is an ERISA-based plan. It's a defined contribution plan that really is investing in the stock of the company. So when I say the employees buy it, I'm really being a little flippant there. The employees are not buying, the stock's being bought by a trust. And the trust is really owned by the employees. But the employees are really never owning the stock in an ESOP. The trust owns the stock, and the employees own a percentage of that trust. And one of the best things about an ESOP is that there are tax advantages of an ESOP if you do sell it to an ESOP that are really second to none. Business owners to sell their company and their employees to have some ownership interest in that is something that the government wants to promote. And so they're giving an owner significant tax benefits for doing that. And so that is really a wonderful thing. Essentially, it's selling a business. You could structure it so that there's no tax at all in an ESOP transaction, which again, I'll say that again, you could structure it so there's no tax at all in an ESOP transaction. That's unheard of. Okay, so again, I spoke about some of this. Who is the buyer? The buyer is the trust. There's a trust that's set up in order to really buy the shares in the ESOP. And again, by definition, a trust needs 10 employees. So you need 10 employees in order to set this up and meet the requirements of this particular transaction. Who sets the price? That's another one. How do you determine the price of an ESOP? And that's really based on an independent valuation. You have to get a third-party valuation of the stock of the company. It's got to be done independently. There's really a transaction. There's legal involved. There's valuation involved. The trust has to actually hire a valuation firm that does an independent valuation of the company. And that valuation is done based on a lot of the standard valuation methodologies, discounted cash flow, market price, and that's how the price is set. It's not going to be more than fair market. It's not going to be less than fair market. It's what is really fair market price.
It sounds like a third-party independent appraiser. Some of the investors will do this. They'll go into a deal in their IRA and then they will swap it to the Roth, and then in that process they'll get a third-party appraisal that gives a little bit lower value than what they originally went in. Have you seen people do that, or is that the same type of firms that do this?
Well, but it's by an independent valuation firm. There's hundreds of them out there. This has a big valuation practice. All the big accounting firms have valuation practices. There are third-party, very reputable valuation practices. There are all different boutiques. But it's got to be a qualified valuation firm. It's a similar fair market value. There's a cost associated with that. Usually, depending on the size of the company, it could be anywhere between $5,000 and $10,000 or $15,000 for the valuation to be prepared. But it's done every year. And again, it's done based on a fair market value valuation, based on the fair market value of the shares. And that's one of the unique things about an ESOP. So that would be an added cost that now is incurred every year as a result. And that's just by definition. You need to get that done.
Maybe I'll reach out offline and we'll swap some contacts there.
How is it funded? That's very unique and very interesting. And that really goes into the type of company that really is a good candidate for an ESOP. And I use the term leveraged. So leveraged ESOP means that there is funding, normally bank funding or bridge funding or outside non-lender bank funding, but there is some type of funding or seller funding. If you, Lane, or I own the company, we could essentially take a seller note back for the value, and we could get paid over time using under that seller note. So an ESOP is funded with that, and that really makes it very unique. The shares are allocated. Again, all the employees, when you do an ESOP, all the employees participate. You can't say, no, I only want these guys to participate. Everybody, all the employees in the company participate, and they get allocated shares in the company based upon their payroll. So if someone is making $50,000 a year, they would get a lower allocation than someone made $150,000 a year. They'd get a third, but they would get allocated.
So you imagine, like, when you create this thing, you have a roster of all your employees, and is each employee given like a percentage of this ESOP based like their current salary or comp plan, or like how's that determined?
They're not given anything on day one. What happens is, if there's a roster, if there's 20 employees in the company, those employees, whatever their salaries are, their W-2 wages, those W wages are ultimately going to be how the shares get allocated to them. So if, for example, there's $1 million or $100,000 of shares allocated to the ESOP, in year one, that $100,000 is going to be allocated to the employees. The value of the shares, again, it's all based on fair market value, is going to be allocated to the employees based upon their percentage ownership based on their salary. So if you had $1 million of salary of your employees and I made $100,000, I would get a 10% allocation in that year. If you were making $200,000, Lane, you'd get a 20% allocation. And then that allocation goes into it's like an account. And then it gets vested almost like a 401k plan. It would get vested over time. You don't get immediately vested. Usually it gets vested over 5 years. It could be 20% a year. It could be based on different cliffs. There's an allocation period where, the employee vests over time. And then once it vests, then it's essentially theirs. And then that value is their value that they actually own and that they can monetize really when they retire or when they leave the company.
The thing about employees these days, as we talk about in these Vistage meetings, people come and go, right? People are flaky and transient.
The point is, when you have an ESOP and the employees participate in the ESOP, the way that they participate is that as the ESOP gets funded, they never get shares. They really get the right to shares. So every year an employee gets the right to shares depending on how the ESOP is funded. And those shares get allocated to the employees really based upon their W-2 wages compared to the W-2 wages of everyone in the company. So it's like a percentage allocation.
Okay, so this protects the business owner from the people who stay less than, say, 3 to 5 years. And then say somebody stays for 7, they get calculated an amount. And at that point, on their last day of work or whenever it is, they're given a price to exit, or is that kind of how it works?
Yeah, something like that. Every year, what happens every year is the employees get a statement of what their ESOP shares are worth. And that's done annually. So at the end of year one, if I allocated $20,000 worth of shares to you, Lane, you'd get a statement at the end of year one saying you've been allocated $20,000 worth of shares. That's in your account. And as of the end of year one, you have not vested in any of them because, again, or maybe you invested 20%. into those shares if you were at the end of year one. Now at the end of year two, again, there's another valuation done every year, and then as the shares get funded, you get allocated those shares. So maybe in year two, the shares might have went up in value, and maybe we allocated $30,000 of shares to you, and now you have $50,000 in your account. In that $50,000, now $20,000 from year one is 40% vested, and $30,000 from year two is 20% vested. And that goes on and on. Now at the end of year five, that first tranche from year one is 100% vested. And again, those shares are not worth $20,000 anymore. They could be worth $30,000 or $40,000 or $50,000 today. And again, if you leave now at the end of year five, that piece of those shares are vested to you, and you would get paid out in accordance with the terms of the plan. Now, there are certain requirements. You don't get paid out immediately because, again, there's leverage on an ESOP. And as that leverage gets paid down, that's really when you get paid down. Until that leverage is done, the payout might not be for 8 to 10 years. It's really based on the terms of the plan and how the ESOP is funding itself and how that funding is working. So what are the benefits? What are the benefits of an ESOP? And there are several. The first one is really just a way to diversify and monetize business owners' piece of an investment. And I always would recommend to any of my clients, again, like we said at the beginning, if you have 80% of your wealth in any one thing.
Okay, go ahead.
One of the key benefits of an ESOP is really the ability for a business owner to monetize and liquefy an investment and diversify. Because like we said at the beginning, we said if over 80% of your wealth is in one thing, that's just exposure that ideally you'd rather not have. And so one of the things I know a lot of business owners want to say, let me take some chips off the table. I don't want to sell the whole thing. Let me sell 30%, 35%, 40%. An ESOP allows you to do that. Another great benefit of an ESOP is really the tax efficiency of an ESOP. And what that really means is when you're actually when you're selling this ESOP to your employees, you're actually getting a tax benefit. You're getting a tax deduction for the value of that transaction. So if you determine the value is $1 million or $2 million, you actually will be getting $1 million or $2 million tax benefit. That's a full dollar for dollar tax deduction. That's an amazing benefit in ESOP. And that doesn't happen in year one, but over the funding of the transaction, you will get tax deductions equal to the value of that benefit. So again, if you had a transaction, a $2 million ESOP transaction, and you're in the 45% tax bracket, you will get a 45% tax benefit of that, a $900,000 tax benefit of doing an ESOP transaction. Now that doesn't happen if you do an M&A transaction or if you do a leveraged dividend transaction. You're paying tax on that. So that's why when I said at the beginning, it really matters what you end up in your pocket, not in the value of the transaction. And that's very unique to an ESOP that is not in place in any other type of transaction that we're talking about. The other thing that you get is the ability to continue with the upside of the business. Again, you could sell a minority piece of the company, and if you believe the company is going to continue to grow, which hopefully you do, you sell 30% today or 40% today, and that's fine, that's done. You still have 70%. If the business doubles in 2 or 3 years, you're getting that upside on that remaining piece, which again is a lovely thing to do. So you continue to do that if you do an ESOP transaction.
Yeah, I'll highlight that because that's just a very common occurrence. Most business owners, they're rich with cash flow month to month, and we call it the ATM machine. When you exit your company, you're going to be giving up that ATM machine or that cash flow. Most people, if you're selling for your company, if your company's worth 5-10 mil, which is life-changing money, which I defined in my book and getting up to the third floor of the wealth elevator there, you still want $1 million or a couple $1 million of liquidity, right? Number one, there's a lot of zeros in it. It's cool to talk to your business friends about that. But number two, when you divide it by 24, 36 months, it may not match up to what your cash flow, your ATM was giving you when you're running your operational business. So what Steve's talking about there allows you to take some chips off the table, maybe even prematurely, but whatever, you got to live your life and you deserved it. So that's what that's all about.
Yeah, when you hear about people selling their business, most times, I'm not going to say all times, the majority of times they're selling either all or the majority interest in the company. In an ESOP, you don't have to do that. And it's very easy not to do that. And you get all the benefits without doing that. So that's just again, if you believe in the business, but you do want to take some chips off the table, it's a great discussion point. Also, the last item, just productivity and retention, is that it's a wonderful way to do something amazing for your people. Your people, at the end of the day, there are companies that created millionaire employees, people that are everyday people making $50,000, $80,000, $100,000. If they're with a company that grows from 8 million to 10 million to 20 million to 40 million to 50 million, and they're with that company for 25 or 30 years, at the end of that period of time, literally, they have a nest egg that they did not pay 1 penny for that's given to them. It is a gift that you've given to your employees for nothing. And it could be life-changing for them. That is a great productivity tool. There are statistics out there that ESOP-owned companies do much better financially than non-ESOP-owned companies because the employees are vested in the company. They want the company to succeed, and they do everything in their power to make the company more successful and more profitable. And they benefit by that. And that is an amazing benefit that you just cannot put that in place in any other transaction. It helps the company be productive and your employees to stay. Hopefully, I know the new millennials, they don't want to stay. And look, you can't force people to stay. I'm telling you right now, I have clients that are ESOPs and now in year 10 or year 12 of the ESOP. And the people that are staying are looking at their statements, and their statements are saying there's 150, there's 175,000, there's $200,000 sitting in that account for them that's just waiting for them, and it's just growing, and they haven't paid a penny for it. Great benefit.
Yeah, I'm the worst employee in the world, so I would look at that as, well, these guys now have me. They have me.
Again, it's so hard to keep people today. And again, I'm not saying this is going to do it, but it's not a lie and it's real. And it's certainly as good as anything I've seen out there. A great way to, and this everybody, again, I'm not talking about only the executives. I'm talking about the guy cleaning, wiping the floors and sweeping. They're also participating in this plan.
We talked about the pros, right? And
yeah.
Let's focus in on the cons here.
There's a whole bunch of areas where it doesn't make sense. One is, I mentioned earlier, if an owner wants to get every last penny out of his company, he probably is not going to want to do an ESOP because an ESOP can only pay fair market value for that's all, not a penny more, not 1 penny more. And if some companies believe, again, fair market value is really based on a cash flow perspective, but it's not paying 20, 30 times earnings for a company. That's just not the way ESOPs are going to be structured. Most ESOP transactions on an EBITDA or on a cash flow basis, generally between 5 to 10 times cash flow. And that's probably a realistic value for an ESOP. And again, some industries are not paying that. Some industries are paying more. If you're in certain businesses, you might be able to get more. And if you could get more, then you're not going to want to do an ESOP. It's a complicated transaction. I mentioned ERISA. I mentioned benefit plan. There's stuff that you got to stay within those rules. And people sometimes are afraid of that. I don't think they should be afraid, but they need to be within that parameter. They need to be doing things right. So if you're not prepared to do that and stay within the rules, if you don't want all your employees, for example, to participate, you just don't want them to because you don't believe in that concept, then you're not going to want to do an ESOP. It's not going to be for you. Sometimes too, again, financially, because there's leverage involved in an ESOP. Generally in an ESOP, you need to leverage it up, meaning that you need debt. And people are afraid of debt. If you have a balance sheet already that's full of debt, if you're leveraged up to the kilt already, you're not going to be a good ESOP candidate because you're not going to be able to finance an ESOP. Right? If you have no ability to borrow money because you're already borrowing every last nickel from the bank or any other lender, you're just not a good ESOP candidate at all. Now, the seller, for example, if you or I own the company Lane, even if we did that, we could still do a transaction, but essentially we'd have to finance it ourselves. We'd have to be willing to take back seller notes. And again, that could be done, but a lot of owners don't want to do that. They want to take money off the table. And again, if you want to take every last nickel off the table, an ESOP is not going to be the best thing for you. You can't be a pig. I'll say it, right? I say it to my clients, bulls and bears make money, but pigs get slaughtered. If you are a pig and you want to suck every last penny, it's not going to work for you. An ESOP is not a good transaction.
But like you said, if you have a wonky business where your financials are a little unexplainable, it's hard to find buyers, right?
Exactly. ESOPs are great for that, but you have to have cash flow, right? So look, there are businesses out there right now. I mentioned cannabis. Impossible to finance a cannabis company today. Great candidate for an ESOP. Construction companies. Very difficult to buy. People don't like buying construction companies. Percentage of completion, it's very complicated. People don't like to buy them. But there's cash flow. Great ESOP candidates. Staffing companies. Staffing companies have all these employees that are working, especially if they're doing temp agencies. They're generating tons of payroll. So there are companies that are good ESOP candidates. And again, there's companies that aren't. And again, one of the last item there, one of them is the ongoing maintenance. Like I said, there are ongoing things you need to do that you wouldn't do before. You need to do evaluation every year. That's going to cost you $10,000 or $15,000. You need to prepare financial statements every year. You don't need to do an audit. You might need a review. You probably won't, but you'll need to do something, and that you may not be doing that now, so that'll be an ongoing cost. You'll need a third-party administrator, like you do for a 401k, a benefit plan, to allocate the shares every year. That's again a cost of $5,000 or $6,000 a year. You need attorneys to do a transaction. Like any transaction, this is an M&A transaction, and it costs money. And again, the last item is an ESOP is a terrible transaction if the business is in a downturn. That's like any company that's leveraged, no matter whether an ESOP or not. If you're leveraged and the business takes a downturn, that's not good. Either you have a third-party lender or a bank, and the business is going from 10 million to 8 million to 5 million, that's just not good. And it really becomes problematic in an ESOP. You got to negotiate. And again, it's just a problem. Leverage is not your friend. So if you're afraid of leverage, an ESOP is not going to be good for you.
In particular industries, right? Like companies with like high inventory, right?
Look, for example, I had a client many years ago that was in the women's dress business. Very unsexy business. They sold dresses to mother of the brides, if that was their thing. And that's a really old, maybe stale concept. But this company was making money. They were doing significant volume. They were making 10, 15% bottom line profit every year. The owner was in his 60s or early 70s. He wanted to sell. And he went out to the markets of private equity investors, and they had no interest in buying the company, not at a good price. They didn't like the industry. They didn't think it was sexy. Even though he made money every year, he was making, like I said, 10, 15%. They were offering him 3 or 4 times earnings for his business. And he said, screw you. What do you, that's ridiculous. Makes no sense for me to sell at that valuation. I'll continue the business, and I'll make my $1 million a year, and I'll be fine. So we said, let's do an ESOP. Let's take a look at an ESOP transaction. So like I said, the ESOP is based on valuation, based on fair market value, based on a cash flow methodology. So the ESOP valuation firm came in, independent valuation firm came in. They looked at the history of the company. The company had a history of cash flow, making 10, 15% bottom line. The ESOP valuation came in, and they came in, they valued the company. They gave him a 6.7 valuation. That he could find. That was very fair. That was reasonable. He did an ESOP transaction, and it worked out very well for him. He also wanted to have his 3 kids in the business, and when he spoke to the private equity guys, they didn't want his kids in the business, or if they did, they wanted to have him on a leash, and they wanted to pay him a certain amount, and the kids didn't want to work for these guys. They didn't want to work for other people. They didn't like that, and they didn't like the idea, and so from a lot of levels, it was an amazing transaction. Another great reason to do an ESOP. This company I'm talking about was a very successful company, very wealthy. The guy didn't do proper valuation. He didn't do, proper estate planning. And he had, like I said, 3 kids in the business. Now the company was making good money, and the value of the company was way up. And so when now he wanted to gift the stock to his kids, pre-ESOP, it was worth a lot of money. We did an ESOP. We sold 49% to the ESOP. We leveraged up the balance sheet. And you know what happened the day after the ESOP was done? The value went way down because now there's debt on the balance sheet. So instead of the company being worth, let's just say $10 million, now the company's only worth $5 million because he just put $5 million of debt on the books. Now we did estate planning. He went back and he was able to do estate planning at a value that he thought was reasonable. And he went back, essentially, he was able to go back like 5 or 10 years to when the company was doing half the volume and half the bottom line. It was just a great opportunity to do some great estate planning, really with having the fact that he did this ESOP. So it was amazing what he was able to do from an estate planning standpoint and from a valuation standpoint. And it was just a win. We're an ESOP where the private equity guys just weren't interested in this business.
What about like professional services, like an engineering firm, architecture firm?
Great candidates.
Law firm.
They are great candidates. Actually, accounting firms, BDO Seaman, the big accounting firm, they're an ESOP. There's a company in New York City called Grassi. They're a CPA firm. They did an ESOP just in the last year.
The reason why great candidates is because when they're going through the selling process, they're getting dinged on something.
Why they're a great candidate or why they're not a great candidate?
Why they're a great candidate.
Companies like BDO and architecture and engineering is number one, there's a lot of payroll in those companies because the payroll is really the engine that will ultimately finance the way that the ESOP gets repaid back. And number two, these companies are profitable. They're profitable, they're making money, they're not overly leveraged. And so there's ability to now borrow. So you could do the ESOP, you get some funding and be able to pay out, not 100%, but pay out a good chunk to the selling shareholders. And that normally what happens is that normally the owners do not get, and again, I want to emphasize this, the owners will not get 100% of the value of the company at closing. That's just not going to happen in an ESOP. They're going to get less than that at closing, and they'll get paid out over time, normally 3 to 5 years. And that's something, again, they got to believe in that. You got to believe the company is going to continue to grow and do well over the next 3 to 5 years. If you don't believe in that, then you shouldn't do an ESOP. But you know what? If you don't believe in that, you shouldn't be selling it to private equity either. What do private equity companies do? They leverage up the balance sheet, just they're not doing it in ESOP, and they're the ones owning it. And you're paying for it because they're putting that into your financials, and now that debt is being serviced based on your results. The same thing is happening, is that you're not getting the benefit from it.
Yeah, I'm not completely following what is the synergistic thing here. I guess my takeaway is It's just what's the eyes of the beholder, and you go with the highest value. If PE or a buyer is going to buy you at this price, you compare it to how the bean counters, the appraisers, are going to look at it and appraise it, and essentially use that as your starting point.
Again, it's fair market value, and I can't emphasize enough that, again, the definition of fair market value in the valuation sense is really based on the present value of the cash flows. Again, each industry has its own methodology, its own metrics, and again, an ESOP will pay fair market value. Private equity generally pays fair market value as well, but a strategic buyer may pay more than fair market value because, again, they may slide it in, tuck it into their existing operations, and your overhead that you exist with will no longer be the overhead in their business going forward. So they may be willing to pay a little bit more of a premium in that scenario because of that. Generally, a private equity and an ESOP valuation generally would be pretty comparable. But strategic valuation may be higher than an ESOP valuation because, again, they may be willing to pay more than fair market value because of what the synergies that they're going to get.
I think, coming from the dumb real estate guy here, appraisals in our industry are a joke. Yeah, the appraisals in the real estate world, even larger apartment deals, they just look at what was the highest prices, by the way. No, give us your appraisal first. Don't look and cheat at what the answers are.
No, in order to do an appraisal, a valuation of an ESOP company, you need to get financial statements, you need to get projections, you're looking backwards, you're looking forwards, and again, there's a lot of information that goes into that. And again, the other thing is, a lot of business owners, the reason when you do an ESOP, you're continuing with the company. Now again, when you fund this, you don't have personal guarantees, even though there could be. The way that we recommend, most cases, no personal guarantees. But again, the owner is still on the line, and sometimes the owner doesn't want that. The owner wants to be done with it. If an owner doesn't want to have any involvement at all, then he's not going to want to do an ESOP. He just wants to be done and throw the keys at somebody. Now, he could do an ESOP in that case, but again, he's going to probably take seller notes for some of it, and he's not going to get paid out of closing. So he's got to have some continuing skin in the game. And again, sometimes owners don't want that. They say, look, I'm done. I want to get paid out. Give me my money, and I'm done. And again, an ESOP is generally not going to be ideal for that.
The takeaways, people are considering this, you just got to talk to an expert, kind of like yourself, and then you go through the process, and it's all based on your situation. It's not, engineering firms, professional services are more lined up to do this versus a company that has a lot of inventory. It's more what you're looking to get out of the transaction. Do you use a baseball analogy here, right? You get a pitch on the outside corner, and you drive that thing to right field. You go the other way with it, where you get it on the inside corner, you pull that thing, right? So, what is the tendencies here? Every situation is different, but for people listening in various industries, various nuances of their businesses, where are some just rules of thumb that you've seen that this type of business lines up to do this more versus?
So let's say it's an architect and engineering firm. Let's say it's doing $3 or $4 or $5 million worth of billings. And let's say they're making, $1 million a year. So that company should be pretty solid financially, probably not super leveraged, may have a small line of credit, maybe a couple $100,000, but generally I wouldn't think it would need a big line of credit because its customers are paying hopefully within a reasonable amount of time. There's no inventory on the books. And the owner is, let's say the owner could be in his late 60s and he's looking to take some money off the table. He may be making $500,000 or $600,000 a year, let's say. Maybe he's got a couple $1 million on the side, maybe he doesn't. And now he's saying, what is this company worth? So I would tell you the company's probably worth $5 to $7 million. And let's say he wants to sell 49% of it to the ESOP. So we could sell 49% of the company for $3.5 million. He could do that, and let's assume he's able to finance half of it. He's able to go out to a bank and get a line of credit for $1.5 million or $2 million, and the rest of it he's got to take as seller notes. And that would be paid off, let's say, with that cash flow of the company, should be able to pay off. Now he's going to get $3.5 million of tax deductions, right? Now he's going to get $3.5 million of tax deductions over the life of the deal. Let's assume it's a 3-year deal. So in year 1, I said he made $1 million every year. Now in year 2, now he does the ESOP. He makes $1 million. He pays 0 tax. He's getting $1 million deduction in the ESOP. And he's paying back the bank debt with that cash, right? So now he's saved $400,000. He didn't pay 1 nickel of tax in year 1. In year 2, he makes another $1 million. No growth. He pays no tax in year 2. He saves another $600,000 or $800,000 of tax. He funds now the ESOP in year 2. All the employees are vesting in the ESOP. Year 3, he makes another $1 million. Does the same thing. Funds the ESOP, repays it back. He pays no tax. In 3 years, he saved over $2 million of taxes that he used to fund the transaction. And now all his employees are vesting in this transaction, And the value went down right when he did the ESOP. Now it's going right back up again because all this debt is being paid off. And it's paid off in under 4 years. He he paid no tax on the money he took out. He rolled it over. Again, there's something called, it was almost like a 1031. It's called a 1042 election that he makes. He could roll that over and pay zero tax on the transaction. Whereas if he did a private equity transaction of $3.5 million, he'd have to pay at least 25% capital gains, at least, on the tax. Pretty damn good transaction, I'd say, for him, for his employees.
Yeah, if you need to sell, maybe something's happening in your health, but you're not really ready, the company's not ready, not fattened up to get the top dollar. You put it into one of these ESOPs for now, fatten up the pig, increase the revenue, etc. And then you sell the thing.
Right, yes, because again, let's assume this guy in my example, the owner, he's really the main guy. He's the big rainmaker in the company, so he's bringing in 80% of the business. But he wants to throw the keys at the private equity guy. They don't want that, right? That's not interesting to them because they want him to stay around, but he doesn't want to stay around. That's another reason why private equity deal won't work. But he's saying, look, I want to take something off the table. I want to build a team. If I take something off the table, I'm willing to maybe invest some of the money and maybe build a team of people. Maybe I'll hire my replacement. And then after 3 or 4 years, after I've already taken $3.5 million off the table, maybe the business could grow. And now I got someone in place who could take over the business. I don't need to be there anymore. And now I go to private equity and I show it to them, say, look, you want to buy my company? I don't need to be here now, but maybe I'm doing $5 million and I'm making $2 million. And you could sell 51% of the company or sell the whole thing. But now all the ESOP, you sell the whole thing to the private equity. And now all the participants, that's how they cash out. Now all the employees are getting some money off the table too. So it really is a win-win for everybody. But yes, again, that's another great way. If the owner doesn't want to cash out yet, he doesn't like the idea of selling, or if he's unhealthy, that's not going to be a good scenario for a private equity buyer. Again, the ESOP, you got to be honest to the valuation firm. Right? When the valuation is done, they're going to ask all these questions about what's the future of the company, what do you think the company is going to do, and you got to be honest. You can't say, oh, my company is going to grow 20% every year. You got to prove it because, again, it's based on future cash flow. And that would be something that has to be justifiable. Building in those bells and whistles, it really is, it gives you a lot of flexibility. And I think you just gave a great example where flexibility, you wouldn't have that flexibility in a private equity transaction. You just don't have it.
Taxes, because you mentioned it before, but maybe take us through the mechanism of where's the tax benefits coming from?
Yes. So normally most of our clients today are mostly pass-through entities. They're mostly S-corps or LLCs. But if you do a minority ESOP, if you're going to do a less than 100% ESOP, what normally happens is to get to all these benefits that I'm talking about, you need to convert from an S-corp to a C-corp. And again, that doesn't cost anything. That's not crazy. And it really makes perfect sense to do it. And I'm not sure if you're aware, but even right now, actually, a C-corp is only paying 21% federal tax. So it's not the end of the world from a tax basis. What happens is, so you decide you want to do an ESOP, you close on an ESOP transaction. The day that you closed on the transaction, whenever that is, you elect to terminate your S election and you become by definition a C-corp. Now as a C-corp, you can make this 1042 rollover election as an owner of the C-corp, and you could elect to essentially roll those funds over, and you take whatever funds you got, you can invest them in qualified government securities, stocks, bonds, real estate, whatever you can invest them, and you could elect to defer the tax. It's almost like a 1031. It's really the version of 1031 for companies. That's really what it is. And again, it could be structured so that the owner never pays tax on it, or he could defer the tax. If it's set up so that he actually retires and passes away while this is still in place, then it's a permanent never ever pay tax on it.
Yeah,
and that actually is very likely you could do that. You could structure it in such a way so that's the case, but that's up to the owner to make that decision.
So with real estate, when they always say don't give the property to your kids because they won't get the step-up basis, is that the same case for, say, I passed away unexpectedly?
No, it's not the same way. Because again, if you did the 1042 election and you did that election till death, and now you die and now it goes to your estate, the state gets a step-up. That's the benefit. Yes, no. So you do get a step up in basis, and that's where taxes never got paid on the sale of the transaction. So that's really the power of the ESOP, and that's the benefit of doing this 1042 rollover. But again, that is also complicated, and I'm really doing it at 30,000 feet level. But the bottom line is that is totally available and is totally eligible, and that is real, and that could be structured. So that is actually what's happening. And this is really, I already spoke a little bit about this. Is really when you could really take advantage of estate planning on a kind of go backwards when a lot of business owners don't have the ability to do that. Because once you do an ESOP, you essentially leverage up the balance sheet and the valuation of the company the day after the ESOP is a lot lower than it is the day before the ESOP. And you have the ability now to do some great gift taxing if you didn't have that ability before. And so you could take these exemptions where they're huge right now. There's $14 million. If you have a company worth more than that, you really could do some amazing estate planning where you might not have been able to do that before. And it just gives you an ability to do something that maybe you thought you missed the opportunity. Now you got that opportunity again. It's just really powerful.
And how does that gifting exemption come into play here?
And so in my example, if the owner of the company, like I said, he had this trust company that he never did estate planning. So he owned 100% of the company. It was generating $5 or $6 million of cash flow. So the company was worth 30, 40 million dollars, $50 million. So he could have done gifting then, but he'd be gifting it based on a value of 30, 40, 50 million. That's not ideal. So now he did the ESOP, he put 30 or 40 million dollars of debt on the balance sheet, and now instead of the company being worth 30 or 40 or 50 million dollars, now the day after the ESOP, the company's only worth 10 or 20 million dollars. And now he could go back and say, wait a minute, now I never did estate planning. Now I want to do estate planning. I want to gift my kids and my kids. I want to do some estate planning now. And say now he's doing it on an asset now it's only worth 10 million instead of 50 million. So he just cut $40 million off the value of the asset, and it's a lot more efficient estate planning that he couldn't do before. He could give away essentially 100% of the company with the $13 million exemption, where before he could only give away 30% of the company for the $30 million exemption. That's pretty powerful. That's really how they fit in, and it really gives you another bite at the apple that you just don't get with transactions. If you did the same thing private equity, it just doesn't work. Can't do that.
Are you able, real quickly, to go over real high level difference between the GROP versus the intentionally defective grantor trust?
Normally, I have one of my tax guys on the call with me
This
to
is
go through that part of it.
estate
So
law
I don't
stuff.
want to. I don't want to be honest in all full disclosure. That is not my particular expertise. But again, that's all part of the gifting. And that, again, that's you need an attorney. You would want to have your attorney involved with that. The attorney should be aware of an ESOP transaction. They need to be an estate planning attorney, and then we would coordinate with them on the tax, really to determine really what kind of vehicles are the best vehicles for you to be doing with these transactions. I don't want to give out information that I'm really not the true expert.
I tell our listeners, like, hey, you guys need to be empowered. I would probably say for people listening, like, at least understand what a grantor versus non-grantor trust is. What's that differentiation? And use AI a little bit. But yeah, you're exactly right. This is getting a lot into more irrevocable trusts, land of more advanced things.
I mean, that could be a whole discussion all in itself. And again, I would want to do that justice, and I want to make sure that we have an expert on the call that really knows exactly what they're talking about.
Yeah.
And again, go ahead.
What's a 1042 rollover?
Yeah, the 1042 rollover is what I was talking about, is when the selling shareholder now has got the ability to defer or even eliminate the tax on the transaction by essentially taking the proceeds from the sale and investing them in qualified replacement property, qualified investments. And by doing that, you make what's called a 1042 rollover election. Again, it's very similar to 1031, where you actually deferring the tax, or you could actually, if structured properly, fully eliminate the tax on the transaction so that you really sold the company to the ESOP really with no tax at all. And again, that's really the power of an ESOP that you just can't do with another transaction at all. So what happens is the owner within 12 months of the transaction has got to invest the proceeds into what's called qualified replacement property. And generally, there's a lot of different opportunities to do that, all different types of property. And that's different options that the owner has. And again, that's an option that the owner makes. He doesn't have to do that, but if he wants to defer the gain, then he does do that. So that's really where the wealth advisor gets in play. We bring the whole team in, his wealth advisor, his estate planning attorney, to really go over that, and that's all discussed well in advance, and it's all planned out.
Yeah, I mean, and this would be a situation where if you run a business and you look long term in the future, like technology is just getting away from you, and the future doesn't look bright. So maybe you like to take some chips off the table, 1042 roll over into another business that may not be more lucrative now, but maybe more long-term, more stable. That might be an idea.
Generally, these monies are normally invested very conservatively, to be honest with you. Again, it really depends on the owner, because you can't buy and trade these securities. Once you buy them, you need to stay with them. You're not trading. So you're buying really a portfolio of certain types of properties, of certain type of government securities or equities, but you're not trading. You could buy another business, but you wouldn't be able to trade it. If you sold it, that would trigger a gain, unless it was sold after the selling shareholder passed away. Again, that makes it a little bit more complicated.
Probably just good to just contact Steve here. I think the cool thing about working with business owners is there's not too many of y'all out there. and you guys are well qualified. That's your best contact there,
Thanks.
Steve? If people get a hold of you. There's contact information out there. We just picked one very common tactic that folks, business owners exiting their company will use. We'll put this up on the website and the YouTube channel for folks to review later on. But yeah, thanks for jumping on, Steve. We appreciate it.
Thank you. I appreciate your time, and I'll be happy to speak to you with no obligation whatsoever.